Hey, this is Justin with daytradethemarkets.com, and I wanted to do a bit of an educational video today talking about trade exit management. We've done other videos, and I'll link to those as well, about trade exit management, but I think that sometimes this is an overlooked part of trading that's extremely important. I think most traders tend to focus the majority of their time on trade entries and finding good trade entries, and certainly that makes sense. I mean, if you think about it like I tend to use a lot of sports analogies, but if you think about it like a golfer, there's a saying, drive for show, putt for dough, right? Kind of the same thing with trade entry versus trade exit as well. When you're hitting the driver off the tee, that's kind of your entry into the hole, and that's obviously very important. You're not going to be a successful golfer unless you're good at driving the ball. Same thing unless you're good at getting into good, you're good at trade entry. But unless you're a good putter, in other words, exiting the hole, trade exit in this case, to continue that analogy, that's where you really make your money is in trade exit, and that's why the best putters on the golf tour tend to make the most money because they know how to get the ball in the hole, right? So what I want to do in this video is really talk about successful trade exit management and actually give you a strategy that you can apply to your trading, whether you want to use our software or your own method. I think it can be pretty helpful for you. But before we get into that, let's talk about very quickly the goal of successful trade management. Obviously, to me, it's in two parts. Number one, maximize your gain on winning trades. You're not going to win every trade, but when you do, you want to maximize the gain on those winning trades. That doesn't mean always hit the home run. That means sometimes, understanding when the market's not going to have a big runner and getting out for a small win, okay? It's just knowing the situation and maximizing the gain on those winning trades and then minimizing loss on losing trades. So if you can avoid taking a full stop out on certain trades when new evidence comes in, that's all the better. And this might seem like a minor thing, but it's incredible how much, if you can make improvements to these two things, it's going to make such a small improvements to those things. It's going to make a large improvement to your profit and loss statement, to your bottom line over the course of a month or a year. And if you just as an example, do this in your head or actually do it for real, go back over the past month or the past year of your statements and just imagine if you could have on average taken a tick more per winning trade or just lost one tick less per losing trade. I think you'll find that it's a pretty staggering difference. That's why this is so important and such a big piece of the puzzle. So I want to show you a strategy that you can use. But before I do that, I want to talk about kind of one of our core beliefs, and that is that not all situations are the same. And to be a successful trader, you really need to be able to determine how great an opportunity is compared to how much risk you need to take. And that's something that we hit on all the time in our member webinars, is that you have to be able to, when we teach this, we talk about this all the time, but try to be able to determine how good of an opportunity exists at the present moment when you're thinking about a trade, and then decide, okay, how much risk do I need to take to try to exploit that opportunity, and then determine if it's worth it. The problem is that what we've seen, and certainly it's something that I've done in the past as well, is that a lot of traders tend to look at all trades as being equal or close to being equal. In other words, use the same amount of risk, use the same dollar stop amount, use the same size position, manage the trade the same way, no matter if it's a good opportunity or a bad one. It's just kind of one size fits all approach because it's easier, it's systematic, or whatever the case may be. I think if you do that, though, you're leaving some money on the table. You're not maximizing how good you can be as a trader. To give another one of our core beliefs is we really think context first, and so I think it's easier to talk about this in terms of trade entry, and then I'll show you how to use this in trade exit. But what we mean by context first, then trade entry, is if you think about how most traders trade, they're focused on their trade entry. They have trade entry rules, if A and then B and then C happen, then I'm taking a trade. And so what happens is, if you're a momentum trader or a trend trader, and you happen to be in the midst of a breakout or a trend, you're going to do great. But if you're taking momentum trades and the market's in the consolidation phase, you get your head ripped off, right? So, but that's how most people trade. It's like, okay, if my rules are met, then I'm going to take the trade. The way that we teach it and the way that we really try to focus, in teaching people to do it and how our software really operates nicely is that we want to put the market in context first. So number one, can you determine determine, are bulls or are bears in control? To what degree are they in control? Is the market in more of a vertical breakout phase? Is it more of in a horizontal or consolidation phase? And all of these different ways of putting the market into context. Now, once you've put the market into context, then and only then do you focus on trade entry. If you can do that, if you can flip around that idea, I think you will find that it makes just a huge difference in your trading. It's subtle, but it's huge, right? So if you understand what I mean by context first, then trade entry, then I think you'll understand what I mean by context first, then trade exit. So the same idea applies. It makes sense that if you can identify that, for example, bulls are in control and they're massively in control, you're going to manage a long trade differently than if you consider that the market's in a horizontal or consolidating phase, or the market's more neutral. In other words, context matters. And if you can understand that in real time and then manage your trades a little bit differently, and you're never going to be perfect. You're going to, you're not always going to be right, but if you can learn to put trade exit management ideas into the context of the market, you will find that you start maximizing your win on winning trades and then getting out of trade, losing trades a little bit earlier. And that makes a huge difference, as I pointed out earlier. So let me give you a bit of an example. And again, you don't have to use this exact formula. I'm not even saying that you need to be, systematic about it at all. I'm just talking. I just want to use this as an idea to kind of get the concept through, and then I'll show you some examples at each 1 through 5 scale. So, one way to look at it is you're asking yourselves, and this is something we teach all the time. If you don't have a method of doing this, I would recommend write us an email. We'll get back to you on how we do this. But basically, the level of the opportunity or the condition of the market should dictate how you manage risk. And again, so it dictates how how much risk are you willing to take on a trade entry based on the, if the opportunity is outstanding, you should be willing to take a little more risk to get into that trade. Same thing on trade exit. If the opportunity is outstanding, you want to give that trade a little more risk. You want to manage your risk on the profitability side a little differently than if you needed to be more nimble and the market was more neutral or more bearish. Okay, so let me give you an example, just using this 1 to 5 scale. And this, again, doesn't have to be systematic. Just the idea, if you had one of these little, toy spinner boards on your desk, for example, where you could determine for yourself, is the market like a 1, a 2, a 3, a 4, a 5? Is it very bearish? Is it neutral? Is it bullish? Is it very bullish? So you're asking yourself, what's the condition of the market at any time, and that's going to help you determine how you're going to manage a trade. So for example, let's just for the case of this example, let's assume we're taking a long trade. Let's assume we're buying, and for this, let's assume we're very bearish. So the market's very bearish. The first thing you should ask yourselves, do you really want to take the trade? I can't really think of many situations where you would take a long trade when the market's very bearish. So that can help you avoid some bad trades, as opposed to just taking every single trade that comes along. If you have a long trade setup and you can see in real time that the market's very bearish, by all means skip that trade. Don't try to talk yourself into it. Just skip the trade. Okay, so that's the first thing. Now, let's assume, again, on all these, let's assume we're buying, we're taking a long trade. In this case, we're looking at a category 2 or a bearish trade. And again, I would ask, are you really sure you want to take this trade? Is this a trade that if you took 100 times is going to be more than 50-50? I don't know, but if you're really aggressive, or if you're someone that just doesn't have the patience, and you insist you have to take that trade, I would still ask you again, are you sure you want to take the trade? But if you do, what it means is at least have the discipline to know that you have to be what we call nimble with your exit management. And by that we mean that you need to be willing to exit that trade pretty quickly if it doesn't go in your favor. One of the terms we like to use is make the market prove to you that you should stay in. In other words, once you're in the trade, it needs to go your direction, or you need to see some bullish evidence come in pretty quickly to prove to you that you should stay in. Otherwise, you probably should be getting out. If you do have to get in, and again, this is a bearish market and you're getting long, use a target. Don't go for a big win. It's not likely to come, right? I mean, every 5 out of 100 times it might come, but over the long run, what's your biggest expectancy? And that's probably, again, not to take the trade, but if you do, use a target, maybe a 1-to-1 ratio. In other words, if you're risking 8 ticks, go for 8 ticks on the profitability side. Okay, just as I'm just ran an example. Right? So again, really consider if you're going to take the trade. If you do take a long trade in a bearish market, you're fighting the context of the market. So again, be nimble, make the market prove to you that you should stay in, or else be willing to get out, and use a pretty tight target, certainly in our opinion. Next, let's assume again a long trade in a neutral or category 3 market. So in this case, you have an edge. I mean, obviously, the reason you're thinking about getting into a trade setup, you feel like you have an edge, and you're doing it in a neutral market. So you have an edge. It's certainly not massive, but you still want to, over time, get the best expected result possible. So in our opinion, in a neutral market, you still want to kind of keep your, think about managing risk hat on first, right? And so again, use that concept of make the market prove that you should stay in. In other words, once you're in the market, it needs to go your direction pretty quickly. And this is a long trade example. So you'll want to see some buying evidence come in pretty quickly. You don't want to be underwater for too long on that type of a trade. You want the market to prove to you that you should stay in. And if it can't do that, you should probably get out. Also, don't necessarily go for a home run in a neutral market. It's going to come every now and then, but your greatest expectancy would be to have a target, probably a 2-to-1 or 3-to-1 ratio on a target. So again, if you're risking 6 ticks on the trade, your target's probably going to be 12 to 18 ticks maximum. Don't go for that huge win, and again, make the market prove to you pretty quickly that it's going in your direction. And should any contrary evidence come in, so if some selling data should come in, some selling evidence comes into the market, be willing to exit quickly for a break even or a small profit. Okay, so again, that's a long trade in a neutral environment. You're managing risk in this, in this half of the wheel, so to speak. You really just have to protect yourself. Okay, now when we get to category 4, or the bullish condition, and again, we're assuming a long trade, this is where you really have an edge. This is the situation that you're waiting for. This is an opportunity that you really want to maximize, to exploit for everything that it has to offer. But you still want to use a little bit of caution. But this is where you make your money, when you can get a long trade in a bullish environment. This is where it happens. So in this case, rather than being nimble, like we said before, be willing to give the trade a little more time. Be willing to give it a little more wiggle room. That you have an edge. You have a pretty decent edge. So you don't want to get freaked out at every little back and forth that the market does for you. You want to give it some time, have some have some sturdiness about you, and be willing to give the trade a little more room. You know that if you took this trade 100 times, it's going to work out a great percentage of the time. So don't sweat a couple ticks against you here and there. Another idea that I think makes sense in this case is to use a combination of a little bit larger target with, or in combination with, a trailing stop mechanism. So in other words, once you're in a trade, once you're in the long trade, have a target that's out there that's a pretty nice winning trade, and as it's going in that direction, use a trailing stop mechanism. And our aggression bars that we think tend to work great for this. And as an example, let me just give you an example here. This is from Crude a couple days ago. This was a breakout. Let's say you got long. This is a level 3 buying aggression bar, and if you're not sure what this means, or this is the first time, we have other videos that explain what these aggression bars are in a lot more detail, or just let us know with an email at info@daytradethemarkets, and we can explain them more fully. But let's say you get into a trade, every time, and you'll have a basic target there, maybe 4-to-1, 5-to-1, based on whatever risk you took on the trade, and then every successive buying aggression bar, you would place your stop a few ticks below that. Okay, here comes another one. Let's place it a few ticks below that. Here comes another one. Let's place it a few ticks below that. Okay, and then you get stopped out. It's still a nice trade. You've either hit your pretty decent sized target, or you've locked in some pretty good profit, and you've kept the risk minimal while still giving the trade some pretty good room to move. Okay, so again, you had a bullish opportunity. You want to try to maximize that for as much as you can. Now, the next situation is really where, this doesn't come along all the time, doesn't come along every day, but when it does, you really want to capitalize. This is a very bullish situation when you're a buyer. Okay, so this is where you have a major edge, everything's really lining up in your favor, and this is, the potential home run trade. This is where you really want to, this can make your week or make your month or make your year. These are the type of trade, depending on what style trader you are. These are the type of trades that you really want to be pretty liberal with your risk management on the plus side, because these are the type of trades that can really run for you, and you want to maximize this. So earlier when I said you want to make on the bearish or neutral trades on the long, when you wanted to make the market prove that you should stay in this case, we feel like you should make the market prove that you should get out. In other words, you're going to hold your water, you're going to stay in that trade at all costs unless the market absolutely proves that you should get out, and I'll give you an example of that in a moment. The other idea is to be less willing to move your stop up past break even. In other words, let's say that a trade goes several points in your favor, depending on what you're trading. Normally most traders are going to bring their stop up and lock in some profit. In this case, where you have such a strong edge, in the long run you'll find that rather than locking in a small profit, you're better off just, you don't want to maybe keep negative risk on there, but bring your stop to break even and be willing to take a few break even trades where you could have had a small profit, in the hopes that you're going to get some of those home runs. In the long run, it will pay off. So in other words, be less willing to lock in a small profit. In other words, take this situation to, you're either going to have a break even or you're going to have a huge win, right? And you're going to have more break evens. There's a trade-off with that decision making, but you're going to get into some really, really good trades, because again, these are not situations that pop up every day. This is a situation where everything's lined up in your favor. Your edge is massive, and you really want to have the fortitude to maximize the opportunity, right? So when we talk about this idea of making the market prove you should get out, one concept that we like to use is what we call the other side has proven itself approach for exit. So for example, if we go back to that same example as before, where we have the breakout of the earlier in that day's high on a level 3 bar, before, if you're using a trailing stop, you're out here. What you can do, what we'd say make the other side prove that it's come in, is you just keep that stop at break even once you're profitable, and you just let the market. You're not going to get out until you see actual selling evidence, and then even maybe potentially a full bar below some selling. So you can see, you had to hold yourself for a couple hours there where it did nothing. Then we had another breakout longer, still no selling evidence. It's not until we get up to this level that we have a level 3 selling bar, and its low is taken out full bar below, right? So you've actually made the market prove that some selling was actually coming in, and you weren't going to get out until that actually happened. You stayed, and it wasn't until the market proved itself, or the other side, sellers in this case, proved that there was reason to get out, that you would get out, because this is a situation where you have massive edge, and you're willing to accept either a break even or a massive win, right? So it's not every trade, but you can see what I'm talking about in terms of having a method for making sense of the context, the situation, the level of bearishness or bullishness in the market at a given time, so that you can therefore maximize your trade exit decision. Are you going to be perfect every time with this? No. Are you going to wish sometimes that you'd made a different decision? Of course. But if you can think about this and find a framework that works for you, and I think that 1 to 5 way is a pretty good framework that you could probably use, whether you're using our software or some other. You're never going to be perfect, but on balance, over the course of 100 trades, over the course of a year, over the course of a month, this is going to pay off. You're going to make more on those winning trades. You're going to lose less on those losing trades, and it's going to pay off for you. So, in conclusion, that's the goal: maximize gain on winning trades, minimize loss on losing trades, and this is one of our core teaching, ideas. It's all about context first. So it's about what's the market context when you're considering how to get in, and you can apply that as well to when you're getting out. And this is really, kind of the next step in most traders' evolution is learning to put that market in context, learning how to not just look at everything in black and white terms, not like, same thing if going back to the sports analogies, if you're playing golf, not every hole, not every situation, not every shot's the same. And to be a good golfer, you need to analyze the different level of risk on a given shot versus what the reward can be. And that's the same idea here. So hopefully that made sense. If you have other questions about this, by all means, don't hesitate to contact us, info@daytradethemarkets.com. Here's a phone number. There's other videos, a lot of other videos you can see at that link, and it also is linked below the page here. And just don't hesitate to get in touch. All right. Hope you found this educational, and we'll talk soon.